Okay, welcome again, guys. This is the fourth lesson. It is all about the triggers, the one that we always get excited about, or most of us get excited about the trigger lesson rather than anything else. Right, so the first thing that we always need to concern ourselves with is the zone that we are trading in, because that is everything. Andy and I had a discussion the other day, and one of the comments were, if there's a zone, even a monkey would be able to make profit. So you are at the zone and it's a support level and you buy there, you're going to make profits in that area if the support area is good enough. So this is it. It's the zone that we are in that makes that puts the edge in our favor. All these W patterns or M patterns or any sort of manipulations anywhere else on the chart, it's still a W, it's still an M, so which means it's still a manipulation. But the value added is when the M and the W happens inside their important zone. So what do we have as zones? So for us, we have resistance levels and support levels, and also inside those massive resistance and support levels we have trend lines either going up or the trend line is going down. So the zones are all over the chart. It's all over. Yeah, your W can happen all over, anywhere. But what we are looking for is a qualified zone and a qualified resistance that's going to add value to your trade, and it's going to keep you confident. So what is a qualified level and what is an untested level? So for me, the way I qualify a level is that it needs at least 2 touches on that level. That qualifies the level. So to the left, you need to see at least 2 touches. And then your level becomes qualified. It becomes an area where you would like to watch for price action. So it comes to the level and then you start looking. It could also move all the way up to the next price action level, further up, but I become interested for the first time when it gets close to the level, like here. So I'd be looking for one of the setups in this area. Also, if it goes a little bit higher, I'd be looking for the setup again, because remember, the zone is just an area where I become interested. I don't forget about this. If it goes up higher and higher and higher, I would look for that entry. We'll see later on when I start ditching this level and looking for the next level. So a qualified level is when you see at least 2 touches to the left. Even when there is a trend line, you want at least 2 touches before it becomes qualified. And untested. For me, an untested level is, say for instance, you find your M pattern and your manipulation pattern. You've identified this as a qualified level because you saw 2 touches to the left. But then you still need something else to qualify the level even further. Now, what I do is, if there was price action and the level seems to be working out and we start selling, if prices hits 1/3 of the distance from the resistance to the support level, if it hits 1/3 of that, then this level now has been tested already. It's a way of objectifying the level. When do I stop looking for the M pattern? That's what the whole system is all about. It's finding levels, but you need to identify the level, and it needs to be qualified in a certain way or disqualified in a certain way. Because as I said before, the M and the W patterns, it occurs anywhere on the charts. It could occur anywhere. So what we're doing is just trying to filter out the M that happens here or the W that happens there. We are waiting for the level to be hit first. But then what is a level? We need to be able to objectify what a level is. And the way we do it is when we see two touches being respected. That's your second touch there. This always looks like breast when I'm finished, but it's not breast, man. It's a support level. I think I should stop doing this drawing. So it becomes qualified when you get a good-looking pair of breasts coming down to the support level. Yeah, it needs two. Then to qualify this even further, I'm looking for a W pattern now. Yeah. But if this had happened already now I'm getting an entry and it goes all the way to 1/3, sorry, not a half, 1/3. Then the next time this comes down, I'm not really interested. It's already, for me, taken profits here. The guys who's bought here, on this entry, they've taken some profits here. So for me, the area becomes less important. Then my full amount of risk would probably, if I was a 1% trader, then I would trade 1% of my account there. However, prices are now doing its thing. And because of this, it's become less interesting for me. Then I would take a trade on 0.5 risk now, because it's less important to me. Obviously, on this trade, I was hoping that this was going to continue and go. Yeah, but it went halfway. I took some profits off the table, but when it comes back to this support zone, I am taking it as if it's been tested already. So it is a qualified level, but it has been tested thanks to hitting 1/3 of the way through. So it's become less important for me. This is the way I manage my trades. I manage the trade idea in this fashion. Yeah, it doesn't mean that this is completely gone now. It means that when it happens again, use less risk. Yeah, that's all it is. So we are always looking for M and W patterns in the market. But what we're doing is to add the edge, to add the probability that we are going to make a winning trade, to make this probability stronger. We're looking for these at zones and levels. Now, let me draw this. This is what we like. We like the level to be hit there, our resistance and our support there. These are zones. So we want to look for the W and the M's here. And we want to look for them on a trend line going either up. So these become zones now. Or if it's coming down the trend line, we are looking at these as, resistance as our zones. Yeah. So when they are found on the daily chart, like what I do, I like looking for these zones. Firstly, on the weekly there, to identify like the top down. And then I'm dropping down to the daily, looking for this break. And that I'm looking for on the 4-hourly. So these zones becomes important on the daily, on the weekly, on the daily, and then on the H4. Yeah. standard risk for me. If I was a 1% trader, I would trade all of these zones as my full sort of a risk. But zones appears on the lower time frames as well. You have H4. You could also have a ranging situation on an H4. And then what would happen would be I would look for an hourly break of a trend line. But then on this idea, because the zones are found on a lower time frame, on the H4 now, I would be lowering my risk. I would be trading 0.5% on this sort of an idea. The lower the time frame for me, the less value I place on the zone. Yeah, my preferred zones are weekly, daily, and H4 because my time is also allocated this way. If I was a scalper and I was sitting at the chart all day long, I would be looking at lower time frames. My H4 would be equal to my weekly chart, and my H1 would be equal to my 4-hourly chart, and a 5-minute chart would be an entry. The whole thing is fractal in nature. So all these patterns and things are found all over the show on all different time frames. The value gets lowered. I'm lowering my risk as we are traveling down the time frames. And then there is something else. So we have zones in these areas. Support, resistance, trend lines. And then also, this is a zone as well. So prices are coming all the way down and it pulls back into a Fibonacci level, 50%. Yeah. And then that becomes a zone because if you drop down, you might find a manipulation there. Because we do get 50% traders. You could find a manipulation there and then goes up to 61.8. You could look there now because they've manipulated this area. So this becomes zones. Manipulation, and perhaps it hits the 78.6 to come down. So these are all zones. So your trading plan should include which zones you trade. Do you trade off the daily chart or the weekly chart and you only are interested in these zones? Or what time frame do you like? And do you trade this Fibonacci manipulations? Because there are people that are looking at that massive downward move and then they are yearning to get into a trade back short again. And these areas are 50%. They love the 50%. A lot of them likes the 31.8% as well, or even the 23.6%. But mostly it's this 50% one and the 61.8% one and then the 78.6. So these are zones as well. The thing is that we have a whole lot of potential zones on the chart. And whatever is on your plan, this is what you need to trade. Don't trade all of these retracements. Trade the ones that you find you are happy with. For instance, there was a three-legged trend. There was one leg, it came down, it went up to 50% retracement. And then it comes down again. Then the next guy says, hey, look, I am going to trade if there's a manipulation. Because of that, I'm going to look for a manipulation here. So I'm looking for this pattern again on the 50. But then your target is going to be there. Yeah. That's your first target. Don't take that trade if this is not big enough. But these are all zones. We are looking for manipulations the M and the W pattern in zones. Yeah. I can't stress enough that the M and Ws are found all over the show. The secret is to stick to the zone that you prefer. Right, so the first setup that we're going to go over is, so we're going to assume that everything is already in a zone. We know what a zone is, yeah? It's got your two touches here. Oops, sorry. It's got your two touches. It has your two touches here. Yeah. So it's qualified now. So you're looking for the M. And also it hasn't gone through 1/3 yet. So it's an untested area as well. So you're looking for this M. So all of the entries that I'm going to show you now is we are going to assume that they are all in zones. Yeah. However you identify the zone. So we have the first one. This one forms part of the beginner strategy, the RSI divergence. Now, if you notice here, it looks like an M. There's my M pattern. So how do we qualify this M now? So with the first one, it is with our RSI. So prices are making highs here. RSI made a high. And then prices are making higher highs. However, the RSI at the same point is going lower. So this entry is our beginner strategy one. That's our first M pattern, our first manipulation. It's a stop hunt. All of them are stop hunts. We don't trade anything if something hasn't been hunted somewhere. Some stops has been taken out. There's some manipulation happening in the area. But the pattern looks the same. Whether it be a complex one like this, it's still an M. We're still taking that and that, that and that. It doesn't matter what's going on, how many times it looks like this. Yeah. We are identifying a simple M like this or a complex one, but it's based on exactly the same thing. Here we're just accumulating more. We're in a massive accumulation stage here. With the simple one, this is what we like to see, just easy and quick on the 15 minutes so we can close off and make profit for the day. But this one is, oh no, I didn't get in properly. Oh no, constantly up and down, up and down. And then there's nothing we can do about this. The best way of doing this actually is just to place the trades underneath the safer area here and put your stop loss above there. But this is your beginner strategy entry. And it's a manipulation, the same as all of these strategies, all of these entries are going to be. So they are all traps. Yeah. They are Fibonacci traps. This is the next one. The M and W, but Fibonacci traps. So these are qualified areas, both of them. We have two of these fib traps. The 123.6 and the 161.8. Two fib traps. So again, we're looking for an M pattern. Untested resistance and qualified based on 2 points there. So what is going on here? So we are qualifying the way this M looks. That's all we're doing. So that we don't take all of the M's. So that we don't take all of the complex looking or all of the simple M's, even if they are at the tested and untested resistance here. Even if they are at a qualified area, we still don't take all of the M's. We're qualifying them. So what we do is we find the highest point here. And we have, I'll show you on a chart later, we find the highest point as prices are going through. And we take a Fibonacci tool and we draw it down to where it's come retraced at its lowest point. And then the next leg up here, this next leg up is our the highest that it can go to qualify the 123.6 entry. Because prices can go much, much higher than this. And then we're disqualifying that. And the way I like doing this one, the way I like entering this trade is the candle close for me is quite important. So I don't like a close of a candle, a bullish candle up there, and it's actually closed there. I don't like that. What I do like is it comes up there and it comes back down and it's unable to close there. So I have that. And then starts coming down. This is what I like. I don't like a close up there. So I find my highest point, take my Fibonacci tool down to the 0 to where it's retraced the lowest before moving back up. And then this is my 123.6 area. And then I'm looking for the candlestick not to close above it. It doesn't really matter. It's just for objectivity. What exactly are you looking for? So I am looking for this exactly. A perfect setup like this, so that I can feel confident when it actually hits my entry point here. And then I don't really care if it gets down there or if it goes up there. All I'm concerned about is that I took a decent entry that I can now name as a 123.6 fib trap. You can ask me any questions about that later if you do have it. Yeah. And then we have the 161.8 fib trap as well. Exactly the same thing. Prices has made its high and you're coming down to the lowest that it's been before it goes back up again. Now, this is the longest one that I will ever take. Yeah. So if you look at this, how is this actually helping us? Let me show you. As I said before, the M's happens all over the show, and now we're even adding some more filter to our entry. Is we saying that it goes up, all right? That's the highest point. We put our Fibonacci there, and it retraces. Now it follows through, and it hits our 123.6. So I'm still happy to go short and take that as an entry. And the highest that I will consider this as a qualified entry is 161.8. And the same thing, the close of the candle. Yeah, close of the candle needs to be below there. Don't like it when it does that, closing up there. Like the close below. So the last leg is pushing up. And if it then goes further, I disqualify the M. And then I'm not bothered what happens if it works out later on. What matters is that I've taken a 161.8 and it was perfect, and that is what matters. It's so that you can then identify what it is you like to trade. If it goes further, I'm assuming that it's just following another trend going up. It's continuing. That is my assumption. Doesn't mean that it always happens. Yeah. I take it at 161.8 is the highest that I will ever look for that turn in the market there. Otherwise, you can look for M's that looks like this. You know, you can go on and on forever. You need to objectify what it is exactly you are looking for. If this isn't objectified, you can take anything, any pattern, anything. Yeah. So objectify the M and qualify your M's. I don't take them all. Yeah. I have a plan, and it would state I only take 123.6 or 161.8, but I'm not taking them all. And then it comes down, and then away we go. But as long as we are qualifying the M and we are making sure, a lot of guys are, we have different brokers and stuff. So on one broker, it might have reached our point there, and other times, and then other times it just misses it before coming down. So you need to decide whether you are going to only take a trade once it hits there perfectly, and then you start looking, or are you going to be interested when it's 5 pips away from that area, or 2 pips away from the area? Now, what I found was that if I have that sort of leeway, and then one day I'm taking it 5 pips away from the zone, the next day I'm taking it 2 pips away from the zone, so it's never objectified. So what I'm doing now is, if it doesn't touch the level, for me, I don't take the trade at that level. I don't qualify it as a 161.8. But if you can stick to an idea where it goes up and it misses the level by 5 pips, and you say that's the leeway I'm giving it, and then by all means stick to it. Yeah, because on another guy's broker, the price might have hit there. Yeah, this isn't a perfect price here. The brokers are making up their own prices. Right, so the common denominator with all the entries so far is that we had follow-throughs. Yeah. So we had our M pattern, and all of them had a leg that followed through. So it's up, down, and then this leg followed through. So where did it follow through to before you qualify the M? It was at 123.6, or you are okay with 161.8. If it goes any further, you disqualify the M. It's still an M, but we disqualify it because it's gone too far past the 161.8. So all of these things followed through. Follow through is that it looks as if it's going to trend. Yeah, it looks as if it's trending. Follows through. The next, so we had here the divergence trade. That is also a follow through trade, and then these two. So that's 3 entry types. So you're looking for these 3 entries at an area of importance. So the next sort of a trade is also an M and a W, but this one, the next one, fails to follow through. Hello there, Justin. So the next one now fails to follow through. So you have a pattern coming up to a level, and it looks as if it's following through. Yeah. And then it comes down, and then is this one going to follow through or not? This one decides no. And it stops, and then we have an M that looks like this now. So our first M, where it follows through, looks like that. And our second M looks like that. That's the point there. That's the point there. So how are we going to qualify this one now? That is the question. So this one, it fails to follow through at a certain Fibonacci level, a certain Fibonacci point. And what we're going to use is the 78.6. So it's an M pattern at a qualified untested zone, and it fails to follow through at 78.6. That is the qualified M that we're looking for. So the reason why we do that is so that we can objectify the M again. So we have prices going up, it comes down, and then 78.6 is what we're looking for, not that. That's disqualified. It's a failure to follow through, as prices doesn't follow through, but it fails at 30%. So we don't want that one. Yeah, we're looking for 78.6. Now, all that we're doing here is objectifying that, the way it looks. If you find that you want 30% failure, then in your trading plan, write that you're looking for a 30% fail or a 50% fail, but don't take all of the fails. That is the idea of the whole system. Don't take all of them, qualify which one you are going to take. Through the research that we've done here, we found that 78.6 works the best at these levels. So we have those 4 entry types so far. We have 3 follow-through sort of M's, and then we have this one failure to follow through sort of an M. And all of this can also happen as a complex M. It doesn't need to be like this. Yeah, it doesn't need to look as simple as that. We can also find it as a complex M. So for the next sort of a entry, we're going to need to look a little bit into the psychology of a trader and what sort of a trader we have. Yeah. So at levels, we find ourselves with normally 3 different types of traders, irrespective of what their strategies are. A human being, when they see a level and he's a trader, he does one of 3 things. This year is a level. Prices comes down. What does traders do when this is a level? Some of them become level traders. They trade at the level without any further confirmation that they would like to go long, other than that the level has been respected in the past. It's 1988, yeah? Back to the Future. I don't remember. I think it's you go back to the past. I don't know. So this becomes a level now. You have your 2 touches, so this becomes a qualified level. Prices comes down into the level. And as a level trader, you take the trade irrespective of any sort of further confirmation. Again, this looks like a breast. So now prices comes back down now. Yeah. Yeah. And then you get another sort of trader who's looking at breakout. So we have 2 sorts of traders at the level so far. We have a level trader, he's interested in trading that level. And then you have a breakout trader. He's hoping that it breaks through this level. Yeah. And then you get the more conservative guy who also believes that prices should go short, like the breakout trader does, but he wants some more confirmation. He wants a retracement before he decides to go short. So he's looking to trade there. So we have our retracement trader there. So these are the types of traders that we find at levels, irrespective of what sort of a trader you are. Even with Elliott wave, if you have an Elliott wave guy, you have him counting the wave 1, 2, or say this is A, B, and then A, B, and then C, it's a corrective thing going up. So he's expecting to go down. So what he does is he's going to look there, and now he's going to be a retracement trader and trade because he's assuming that's going to be 5. But he's a retracement trader. So irrespective of what sort of system you're using, you are just any of these traders: the level traders, breakout traders, and retracement traders. Yeah. So now we end up with using that information for our next entry, which is the circle of liquidity entry. Right, so how does the circle of liquidity work? Firstly, you find a decent level, qualified and untested. Yeah, and then with the circle of liquidity, you want all of these types of traders in the market. Yeah, you want them trading at this level. Yeah. So what we have is the level trader. He comes in. And the level trader forms the entry cheese. They are looking to go long and their targets are up here somewhere. Yeah. So he forms entry cheese at the level. So he is in the market. We have our level traders there. He's traded based on what has happened here in the past that made him assume that this is a good level. Yeah. Then that's our first type of trader that's in the market. Then we have our breakout trader coming into the market and he's going short. Yeah, he's going the opposite direction of the level trader. So we have two types of traders that are entered based on what they have seen at the level. And then you still need a retracement trader who wants to follow the same direction as the breakout trader. So if we notice where all these guys are most likely putting their stops, our level traders putting our stops here, putting their stops here. Then we have our breakout traders. They are either putting their stops here or here, but somewhere in the area. See, the liquidity is being provided by all the traders now. Yeah. And then the retracement trader, he comes into the market. He's looking to go short at 50% or wherever he wants to go short. Doesn't really matter as long as we can identify that there is a retracement trader who wants to follow in the same direction as the breakout trader. And then all of their potential stops are in this little circle. And then what we do is we enter the market here. Again, we turn into just a normal breakout trader. However, we are doing this after all of the other traders has already been in the market and their potential stops has been taken out. So that there is the circle of liquidity. 3 traders are in the market with their potential stops all taken out. Yeah. Then we have a conservative entry. So it looks similar to the circle of liquidity. However, there's just one further step that needs to be made first before we can qualify it as a conservative entry. So prices are coming down. And as prices are coming down, we need to see where the lowest point is. And the lowest point was made by which group of traders here? We need to identify this. So at this point, this was the lowest point, and they were the ones, these sellers on top here has made that lowest. But then prices came even further down, making a new low point. So this is always going to be a downtrend until these sellers who's made the most previous low has been taken out. Yeah, that's the way we objectify a trend. The trend has never ended until the guy who's put in the lowest low is taken out. The sellers here are in very much control. So irrespective of what happens here, this is still in a downtrend because they are still in control. So based on that assumption, we only start looking to trade long based on the conservative entry when this point is broken. But then we still need a pullback here. We still need this pullback here. Doesn't matter where it goes to. And then that there becomes our entry for the conservative entry. That becomes our conservative entry there. Then we could put our stops here if we are going long, or we could put our stops where we at the more safer area, here at the bottom of the whole structure. It depends on you and how you feel about the risk and your reward. If your rewards are too far, is too close by to your entry, then you might want to use this here as your stop loss. Okay, guys, I'm going to go to the chart unless you have any questions in the meantime. I'm going to have a look to see for these entries on just like the euro dollar or something. But let me know if you have any questions in the meantime. All right. So do you see my charts? Yeah. Okay. So what we have here is just, I'm going to assume that all of the areas here are at zones, because I just want to show you how to find these entries and how the entries are actually looking. Yeah. So if we look at this one here, yeah, prices has come down to a point, and then it goes up, and then how far does it go down again? So what I mean is we are looking for a W pattern because we want to go long, for example, in this area. So we've identified the W like this in this area. You see? So in this one, we are looking at that point. How far low did this go? How far down? Did it disqualify us based on the pattern? Or are we safe to go? So how we do this is we take our Fibonacci tool, right? It's come down, and then where did it retrace back up to? That point up there. There. Then we can qualify this as a 123.6. So this W is qualified. We are safe to take that trade based on the entry method. Need to find these sort of things on the zones and all of that. I'm just looking at the actual pattern. Let's look at this one, for instance, coming down here. We have what an M pattern, but does it qualify? So let's have a look. You can notice the M. So what do we do? From the highest to the lowest. It doesn't get all the way up to the 78.6. So this is an disqualified M. I won't take the trade. So in your trading plan, you need to decide which of these you want to take and stick to those. Test those on your particular time frame and test those on your specific charts that you like trading. Look at this M again, another M pattern. From the highest all the way down to the lowest. And this one doesn't hit the 78.6 either. So that's a disqualified M. I'm not going to take the short here. That is what we are doing. Yeah. Now, I showed you earlier on that we get a lot of zones. Like these are zones as well. Like say, for instance, that's an area of importance there. You've identified that and you've identified that. You've noticed prices coming down here. Look at this. Prices come down to that point and you see it's about a 61.8 Fibonacci. So what a lot of guys are doing is that they're looking for their next entry. So they take this leg now coming down and they look at 61.8 here. There. Now I've taken this trade yesterday based on an area I found important. However, it doesn't match up to any zones that you might have otherwise thought of. The reason I'm interested here is because when prices has come down here the last time, yeah, from there to here, it has turned on the 61.8. Yeah. It's made its retracement to the 61.8 and it's come down. So I'm identifying a zone here. So for this trade, I've identified that now as a zone because of the 61.8 here. Now, if I drop down to the 15-minute here, then this was the area I was looking for a trade in the first place, to go short, because I found a zone. So that's a zone, but is the M qualified? Let's see. So we have a high. It's come down to that low. It hits the 161.8. Exactly, doesn't close there. Everything is perfect. I am interested in taking the short. Not just because it's an M, because I found a zone that I am comfortable with here on the 4-hourly. Yeah, I found that zone. I've looked at this as well as a break, pullback sort of a situation to go short. And these guys were stopped out where? At the 61.8. So I want to find out if I can see a setup on the lower time frame here. And I found it with a 161.8 M pattern. Yeah. So far we saw two different patterns at play. Yeah. Let's just go through the chart here. This one, remember, was our 123.6. And then if we look at this, does this qualify? Let me do, yeah, just any ones here. Yeah. Doesn't matter. Let's look at this, for instance. Prices comes down, yeah? Prices comes down here, all the way down, right? And then where does it retrace back to? That. So we have a W pattern, but it breaks through the 161.8, yeah? And it closes below. I need to remove this, otherwise you can't see. So you have your lowest low and your Fibonacci up to the retracement, but the prices are closing below here. So that 161.8 for me doesn't qualify as the W I see here. I don't like the trade. Yeah. So that one doesn't work out. If we look at this one, yeah, prices comes down. Yeah, all the way down, and then it retraces back up. And again, this one is a 123.6. Don't like that it closed there though. So you need to be like finite here. You need to really measure, and you see this. Would you be able to disqualify this M? Would you look at this? This is 1 pip below the 123.6, and then we start kicking ourselves here because we didn't take that trade because of 1 pip difference here. But at least we are qualifying the way it looks still. Yeah, at least we are qualifying, other than just taking every single W pattern when we hit a level. Yeah, we can go further, just any random sort of one, just to show you what I'm trying to do here. This looks like a 78.6, which means this is your highest high, that is your low. It doesn't hit the 78.6 exactly. This is what I meant by, are you okay with 1 or 2 pips away from 78.6, or do you want physical touching the area? This one here is a 123.6. You take the lowest low, you move it up to the highest high. Again, very close. But all of these, I'm looking at all of these. Remember, we need to find them in a proper, in the proper zone. Yeah. So you identify the zones and then you start looking. For the homework, you don't have to identify the zone. Just give it to me as what I'm doing here. So prices comes all the way down. It goes up to that highest high. 161.8, doesn't close there. There's the 161.8, touches it, doesn't close below. I'm happy to take the trade up here. Yeah. So this is the way you need to do the homework for me. But hopefully this time we can do it on a call. Yeah. So find all of these entries. The 6 different entry types, including the RSI divergence. And then if you want to do it all in a proper zone, then it's all the better. Yeah, you can show me this is the zone and the reason why it's a zone for you, and then you can show me the entry pattern like this one. Prices go up to the highest high there, and then it follows through. But how much does it follow through? We need to decide whether that is going to be qualified or not, and that is a qualified 123.6. It doesn't close above there and it comes down. Yeah, here is another one coming down here. So it comes all the way down to this lowest low. It goes up and then touches the 123.6 exactly, and then it goes back and then it goes up. So these are the things I want you to find at levels of importance. This looks like a 78.61. So it's highest high down to the lowest low, doesn't get to the 78.6. So no trade for me. Next one, you see all these M's and W's and everything all over the show. So we are only taking the ones that actually qualifies at levels. Okay, guys, do you understand? Do you need any? do we have a flip trap only on the flip? No. Look, when we do, like on the daily, Dave, say for instance, we have a daily chart here. Man, let me just remove all of these. Yeah, pure. Yeah. Okay. Let's say this is a daily chart now, right? It's a daily chart. Prices are coming all the way down, down, down. So what are we usually looking for? We like looking for a break of a trend line sort of a thing, right? So, but what already gives us a clue here that it's going to turn? Yeah, this is what gives me a clue. A lot of things, you know all those things, but it comes down and it makes that lowest low, and it goes up and it hits the 123.6 exactly. So when this is an area where I would like to go down to the 15-minute and look to buy in that area, because that's an identified zone. Yeah, I am going to assume that this is the turning point and it's going to go and it's going to break. So I'm looking for my entry on the 15-minute here because I've identified a zone. You can identify zones all over the show. That is a zone for you. Yeah. And like I showed you before, the other one, when prices are Like here, say for instance, it's going up. Let me remove this. It's all about the zone, people. Find these patterns in a zone. So what is the zone here? So say for instance, prices are going up, right? So now I'm going to move. That was my first leg up. Where did it turn? It turned at about 50%. Yeah, it turned at around about 50%. So now my next leg up here, up to the highest point, and then this is where I would be interested in looking at the 50. The next one, sorry, at the 50 is where I'd be looking for a manipulation. And because I like 78.6, I would be looking for the manipulation there, right? And in this case, the 78.6 appears on my 36 period moving average. Highly interested in dropping down and looking for an entry there. So it's all about finding zones and finding what prices done in the past. In this example, prices has come down and it tested an area. So you just assume that it's going to do the same sort of thing in those areas. So you're looking for the 6 entries over the year and you're looking for the 6 entries there. In any zone, any time frame. But when you start messing around with time frames, you need to jump, you need to lower your risk. And when you start messing around with time frames, you're going to have a massive trading plan. Because you're going to look on the daily, on the hourly, on the 5 minute, on the 15 minute. You're going to trade just everything. And when you trade everything, then nothing seems to work. You need to identify which of these zones you want to look for the pattern in. Even a level trader is going to make profit here and there and there and there and there. Find the zones that you would like to trade in. Yeah? I find this zone difficult one because it's trending down. Where can I find a turn when there is nothing for me to look to the left? Where does it turn if I don't have anything? If I don't have anything, I use Fibonacci to help me with the turn. I'll drop down to the lower time frame, look for the 6 entries, and if it works, it works. If it doesn't, it just goes down. But I know through testing that it works in these areas. And this is why you need to do the homework to find out what works for you in all of these different areas. Yeah, it's the zone that's the most important thing here. Do we validate on higher time frame like you were doing on? Yes, the higher time frames is the finding the zone. Yeah, let me show you something else quickly. Yeah, we're just gonna stick on this one. Yeah, on the euro dollar. I'm not gonna go anywhere else. So you've identified maybe that it's going up here, right? Which means you only want to buy. So where would you want to buy in this sort of an area? So you're finding this as a zone now, possible zone to trade in. But look at this. Say, for instance, you've taken this trade at the top here, right? And you are anxious to trade throughout the day. You see prices are going down and you see that this is a level of potential target. So you're very close to the target already. So it's, I wouldn't want to trade here short anyway, unless I was trading it up there. So I'm late for the party because this is my goal. Yeah. But identify this short. So look at this. I'm identifying this short maybe on the 15 minute now. Nothing. So I don't even have a 5 minute. I have to add it for 5 minute thing here. How do you add it? Customize, right? I'm going to add the 5 minute insert. I'm going to add the 1 minute insert, right? So now I'm trying to identify how it's going down, right? So 5-minute chart. No identification here. What I was hoping to find something, right? So this is now my higher time frame. Yeah, this is now my higher time frame, the 5-minute, and then I want to drop down. Didn't I add the 1 minute there? Now on the 1 minute chart, I am looking for the retracement here, and then that becomes my zone. That becomes my zone. This becomes my zone. So if you now test the strategy on the euro dollar on the 1 minute, does it work for you? So prices has come high all the way down, and it hits the 123, and I'm down. Here on the next one. On the next one. You did it all on the higher time frame to find your zone. Yeah. And then you're trying to find a pattern of what's happening. Then all you're doing is looking. Here you have a price coming down. This one doesn't hit, or it hits the 123.6 exactly. Yeah. So that's another trade going short. Every time it hits a zone that you've identified on the higher time frame, then you take a trade. But is that part of your trading plan or not? Yeah, it works on all time frames here, but I would lower the risk, to nothing, because this is scalping, and you'll be lucky to get a 50% win rate, but then you need to keep one trade that that's your losses. Keep the one winner needs to cover up all those losses. And I don't recommend trading on the 1 minute and all that. I'm just saying that, trying to answer Mayu's question, do we always look for the higher time frame? So you find a zone in your higher time frame and look for the M and look for the W that's qualified. That's what you do. I don't care where you find the zone, as long as you stick to it. Maybe later on you will say, look, Rustam, I don't like trading on the daily zones. I like looking on the 4-hourly or the hourly, and I drop down to the lower time frame to look for my entries. That seems to work better for me. Then I would say, yeah, because I might not be trading the same currency you are. You might be trading some exotic Norwegian krona versus, the real. And then that seems to be working. You need to notice the pattern, what it's doing, and where it's doing it. Where the zones are important, right? Good. Test on the lower time frame if you want, Andy. Test it. It works on every single time frame. It's not a new strategy, Dalvin. It's the same strategy. Guess what the strategy is? The strategy is trade W's and M's in a zone. There, the book is written. It's done. I've got nothing else to say. Trade WM qualified patterns at zones. Where you find a zone is up to you. I like finding the zone from the weekly, daily, 4-hourly, dropping down to the 15-minute. Does it make any sense, people? Does this ask your questions? Because I think this, I'm not doing the lesson on the entries again, and I have 3 videos so far. Yeah, and for the 3 different groups, and I really want it to be concise for anybody who's going to be interested in the course in the future. I want them to be able to find the answers in the course material or in these videos that we are doing. So this is why I'm glad for the Andys in the world and the and the Gavins in the world. They make my job very difficult. But then I know the course is concise. They don't know how much I appreciate them, honestly. Justin, sorry I left you out. Justin doesn't make make my life difficult though. He's like one of the nicest guys ever. And Justin is a great example. Guess what he does? He's using mean Renko bars instead of candlestick bars or instead of Heiken-Nashi. But what he's doing is finding a zone and looking for an M and W. That's qualified. The sad thing is that this is so easy to do, but we're making it so difficult for ourselves. And I understand that. We because it's so easy. We think we don't, you know, how could we make money with this? It's too easy. It's like taking money from a baby, or it's taking, the sweets from a baby. It's too easy. So we want to make it more complicated than it already is. Dalvin, you can have a one-on-one with me like anytime you want, man. Just message me and then I'll give you a one-on-one. Yeah, anything you want. Just ask me any questions you have, like now. Yes, there are many variations, and that is why. Yeah, Andy, that is it. Andy says there are so many variations you can apply, but using the same methods and the entries. That there is the answer to the whole thing. I should have just said that in the very beginning, in the first lesson. I should have just said this what Andy wrote and said, okay, that's done. Thanks a lot, guys. Can you just let me know the question that you have again, Justin? Because the bottom screen is small. Mayu says on the 15-minute, how can we take 161? Could it? Yeah. So if you are taking the entries on the lower time frame, as long as the zone you have found is in a higher time frame, you are not trade. That is why if you do that, you'll be trading every single M and W. You firstly identify the zone. A zone means that if it's ranging, then you are looking for it on an horizontal support to resistance. If it's trending, identify the trend with a line or with a physical line, which is your static trend line. Like this here would be my static trend line. But there's the dynamic trend line, which is this blue one, the 12 or the 36. But if it's not respecting it, then it's not a proper zone. Yeah, you need to identify it. You need those touches. You need to identify the zone, then drop down to the time frame. I knew this is going to be exciting for you. This is why I kept it last year, because I wanted you guys to know the strategy well first before messing around with the time frames. But it's possible as long as you've identified the zone. How do you alert yourself to the entry? I always miss it. Justin, I will tell you how I do it. That's the reason I do it with the 4-hourly thing. Because so that I only need to come to the chart every 4 hours to look if I am at the zone. Like here, I was so glad yesterday to have taken this trade, this one, up here. And now I'm going to take profits when it gets down to this level. So what happens is every single time the 4-hourly candle closes, then I'm at the chart. Yeah. So when the 4-hourly candle closed yesterday for Justin, and then I was then unfortunately I had to stay at the chart, because then I am on the 15-minute looking for the W to complete itself, or the M to complete itself. So I'm not missing the entries because of my the time frame. But if you want to be a scalper, like doing it on the hourly and looking for zones, then you need to be there every hour. And then if you are looking for your entry on the 5 minute, then obviously you're going to have to sit there and watch for the price action. But the zones, it depends on how busy you are and what sort of a job you are doing. So I defined I like a 4 hourly gap because I want to, help my kids with the homework and all that. So I need to have this massive 4 hourly gap. Do you see? So what am I doing now? I'm waiting for, I don't really care. This trade is done, but I don't know. If I was waiting on this to happen, then every 4 hours I'm there. Oh, the 4 hourly candle came down onto my level. I better jump to the 15 minute. Then I tell the family, hey guys, I think I'm going to be busy. But then they're quite happy with me being busy because they know I'm going to be making some money at this level or losing some money at the level. Yes, Catalvin, your risk is lowered at these, yeah. But test them. Yeah, look at this one. This one was nice, a nice little stop hunt sort of a. But you can identify this W, can't you? You can identify it. If you can't see the W, you can look at this as stops. So you have entry cheese, breakout traders, retracement traders, and you are in. You see that? Let me draw this. Here you have a level because of that and blah, blah, blah. You have the entry cheese there. Level trader going in based on this level. Yeah. Comes down, breakout, retracement, and then you are in. Done. Next one going short here. That's now my level. How do you qualify that? Can't really do it with the conservative entry. Can't do it any other way other than doing the Fibonacci 161.8 entry there. But not all over the show, guys. That is the secret here. The ones that's going to stick with me in the daily room and the ones that are going to strategy hop are going to be the ones that's going to take the M and W's all over the show saying that it doesn't work. That's just the way it is. I hope it's not going to be the case. There's only 12 of you guys that are doing this live with me like this, and I'm hoping all 12 can see the light here. It works more than it doesn't. And that's all you need. Then your risk management part should cover all your losses, really. So it is as simple as that, guys. Difficult to implement, but I think it's difficult because we're skeptical that how can something that easy work. If there aren't any further questions, then I am gonna leave you, but I'm in that room always. Yes, all of those things, Andy, needs to be taken into consideration, the spreads and all that. If you're doing this sort of a lower time frame stuff, then you need a low spread. Look at the spread here quickly. 2 pips, that is fine. IC Markets has a much better spread, 0 spread. So use like a commission-free sort of a broker, IC Markets in them. Try them. Okay, I'll show you that one quickly. The last of my euro. No, it wasn't the euro dollar. Sorry, was it? 1 second. I need to look at the 4 hourly for that. Yeah, it was this one. Okay, I'll clear this chart up quickly. In the past, some of you might have been Fibonacci traders, right? Everyone learnt about the magic numbers. And a lot of the time, the magic numbers are 50% and 61.8%. And then there is the other one, which is the lower ones, which is 21.3, I think. And I want the other 30-something%. So let's look at this leg down. Yeah, prices coming down. it comes down, and where does it retrace to before making its next leg down? Yeah. Let me know if this is if it's right where I'm going at. Yeah, I'm understanding your question, that I need to just show you how I've taken the trade. Yeah, so it's come down and it's on a 61.8. So what I'm going to assume is instead of my next leg down there was 50%, I'm going to assume that the traders are more interested in 61.1 based on the previous leg. But that doesn't really matter. What matters is that 61.8 is one of those magic numbers. When you learn anything about Fibonacci, this is what you learn. You learn 61.8 is important, and you learn 50%. So there are traders up here. Yeah. And there are traders up here to go short. They want to go short. Yeah. So this is not an idea where I would want to continuously go and crash down, even though I am happy because I'm selling the euro, and I never buy the euro against the dollar ever. So I'm really always looking to sell anyway. So how can I justify the zone? I'm justifying this zone as a 61.8 pullback on a higher time frame, which in this case is the 4-hourly. So I've identified a zone. Now I'm looking at my trigger chart, which is my 15-minute. It comes right into the zone. It makes, look at the pattern. Look at this here. Perfect. It's beautiful. There's action here. Something is going on here. It comes up to the 61.8 perfectly. Again, perfect. Another one, perfect. So I'm interested in finding a M pattern here because I want to go short. So let me draw the M for you. This is the M. This is the M. That is the M. How high it went there makes me interested, and it makes me be able to qualify the M. Let me see. So how high did it go? It's a follow through because it looks as if it's following through. So what do I need to do? I take the highest point there. This is the homework. I pull down to the lowest point. It hits my 61.8 perfectly, and I'm then become interested in the trade, in taking that M pattern. Yeah. So how would you want to take that M pattern? You want to break through the EMAs here? Do you want to take it there? Do you want to take it as a trend line is breaking? It's, it's really all up to you. That's a trend line. It breaks there. You want that and putting your stop loss up there. But what you know is you're interested in taking this trade there. Does that make any sense? Or does that clear it up a bit? Yeah. So for homework, do this homework with me. It's going to be much nicer and easier if I can see that you are finding a zone and looking for these patterns. So the homework is find a zone. I think I said don't find a zone, just find the M's, but rather find a zone. Qualify the area for me, and then find 6 different entry methods. Like if you look at this particular one now, it was a 61.8. Let's see if it also qualified as the first one, the beginner strategy sort of a method, the RSI divergence. No, do you see? This one went higher. So there was no divergence in this one. This one was qualified with a 161.8. Yeah. All right, guys, I think that is that for today. Let me know when you've done it, and then we'll speak further in the room later on. Thanks very much for coming and listening to this one. Thanks a lot, Andy. And you keep on questioning and you keep on coming. Yeah, you are one of the guys that are helping me build this thing. Thanks a lot, Glenn. Okay. Bye-bye, guys.